Hi friends, in this video we are going to discuss about NISM 10A Investment Advisor Level 1 mock test for Module 3. First question, a diversified investment portfolio helps reduce option A tax burden, option B total return, option C systematic risk and option D specific risk. Correct answer is option D specific risk. Diversification reduces company or sector specific risk. Next question. A treasury bill typically has a maturity period of option A 1 to 5 years, option B over 10 years, option C less than 1 year and option D 15 years. Correct answer is option C less than 1 year. T-bills are short-term money market instruments. Next question. What is the key difference between the equity and debt investment? Option A. Equity guarantees fixed returns. Option B. Equity implies ownership. Debt implies lending. Option C. Debt provides ownership rights. And option D. Debt is riskier than equity. Correct answer is option B. Equity investors are owners. Debt investors are lenders. Next question. What does duration in bond investing indicate? Option A. Coupon frequency. Option B. Interest rate sensitivity. Option C. Market liquidity. And option D. Credit worthiness. Correct answer is option B. Interest rate sensitivity. Duration shows how much a bond's price changes when interest rate changes. Next question. The value of a derivative is derived from option A. An underlying asset. Option B. Gold reserves. Option C. Investor sentiment. And option D. Book value. Correct answer is option A. Derivatives depend on the price movement of the underlying assets like stocks or commodities. Next question. You pay 20 rupees for a put option with strike 100 rupees. At expiry, the stock is 90. Your profit is option A 20 rupees, option B 10, option C 0 and option D minus 10. Correct answer is option D minus 10 rupees. Intrinsic gain is 10 rupees, then net equal to 10 minus 20 is minus 10 rupees. Next question. What does a falling PE ratio with rising earnings usually indicate? Option A overvaluation, option B possible undervaluation, option C high debt and option D lower return on equity. Correct answer is option B possible undervaluation. Price is not keeping pace with earnings growth, suggesting undervaluation. Next question. Which of the following provides a fixed interest and capital protection? Option A equity, option B corporate bond, option C futures contract and option D real estate. Correct answer is option B corporate bond. Bonds pay fixed interest and repay capital unless the issuer defaults. Next question. The margin in a derivatives contract is used to option A pay profits, option B reduce taxation, option C cover potential losses and option D increase contract value. Correct answer is option C cover potential losses. Margin protects counterparties against default risk. Next question. An investor wants to earn from price difference between two markets. This strategy is called option A arbitrage, option B speculation, option C hedging and option D duration matching. Correct answer is option A arbitrage. It exploits price differences in different markets. Next question. Which type of investment gives the right but not the obligation to buy an asset? Option A futures, option B put option, option C swap and option D call option. Correct answer is option D call option. Next question. Mutual fund NAV is updated For every, option A hourly, option B monthly, option C weekly, and option D daily. Correct answer is option D daily. NAVs are calculated every business day. A bond is trading below face value. What can you conclude? Option A, it has no interest. Option B, it is trading at premium. Option C, market yield is higher than coupon. And option D, it will default soon. Correct answer is option C, market yield is higher than coupon. When yield greater than coupon, bond trades at discount. Next question. Which instrument is best suited for hedging foreign currency exposure? Option A, currency futures. Option B, mutual fund. Option C, equity shares. And option D, real estate. Correct answer is option A, currency futures. Currency derivatives hedge forex risk. Next question. Which of the following does not represent diversification? Option A, investing in different sectors. Option B, spreading across time. Option C, holding debt and equity together. And option D, putting all money in one blue chip stock. Correct answer is option D, putting all money in one blue chip stock. Concentration in a single stock increases risk. Next question. What is the purpose of a clearinghouse in derivatives trading? Option A, manage taxes. Option B, guarantee trade settlements. Option C, eliminate margin requirements. And option D, create underlying assets. Correct answer is option B, guarantee trade settlements. Next question. Return on equity is calculated as option A, net income divided by total assets. Option B, net income divided by shareholders' equity. Option C, earnings divided by market capitalization. And option D, profit divided by total debt. Correct answer is option B, net income divided by shareholders' equity. Next question. Which of the following is a qualitative factor in stock selection? Option A, ROE. Option B, PE ratio. Option C, management integrity. And option D, dividend payout ratio. Correct answer is option C, management integrity. Qualitative analysis includes non-financial elements like leadership quality. Next question. The primary purpose of fundamental analysis is to option A, trade based on volume. Option B, predict short-term movement. Option C, assess a company's financial health. And option D, track technical charts. Correct answer is option C. It involves analyzing financials, management, and business environment. Next question. Investing 1,000 per month in a mutual fund is an example of option A, systematic investment plan. Option B, systematic withdrawal plan. Option C, lump sum investment. And option D, diversification. Correct answer is option A, SIP, systematic investment plan. It spread investment over time to manage risk. Next question. PE ratio helps investors understand option A, earnings volatility. Option B, stock price relative to earnings. Option C, credit risk. And option D, asset allocation. Correct answer is option B. High PE may indicate overvaluation. Next question. In derivatives, the notional amount is option A, amount of margin required. Option B, actual cash exchanged. Option C, reference amount used for calculation. And option D, strike price. Correct answer is option C, reference amount used for calculation. Notional amount determines cash flows in the contracts. Next question. What does a high price to book ratio generally indicate? Option A, the stock is undervalued. Option B, investors expect strong future growth. Option C, the company is over leveraged. And option D, company has no fixed assets. Correct answer is option B. Investors expect strong future growth. A high PB ratio implies that the market values the company higher than its book value, often due to growth expectations. Next question. Which factor is considered in the cost of carry model for futures pricing? Option A, only spot price. Option B, spot price and storage cost. Option C, market cap and PE ratio. And option D, mutual fund NAV. Correct answer is option B, spot price and storage cost. Future price equal to spot price plus cost of carry. It includes interest and storage. Next question. What does the relative strength index indicate in technical analysis? Option A, price versus book value. Option B, trading volume trend. Option C, overbought or oversold condition. And option D, net asset volatility. Correct answer is option C, overbought or oversold condition. It helps identify momentum extremes in a stock price movement. Thank you for watching my video. Please subscribe for more chapters.